Welcome all. So, in the process of learning about the risk analysis in capital budgeting projects, till the previous class we have discussed some techniques, three techniques that help us to analyze the risk in the capital budgeting projects or maybe in the investment proposals, and there we talked about the sensitivity analysis, scenario analysis, and in the break even point we talked about the accounting break even point, and we talked about the cash break even point. So, now as I told you in the previous class itself that a break even point can be calculated in the three forms, right, because it is a very important point. Break even point is a very important point because risk of the project remains largely up to the break even point. Because our focus is always upon that at what level of the sales our cost is going to be equal to the sales, or vice versa, or sales are going to be equal to the cost of production. That is our first approach. Once we are able to reach at the stage of the no profit no loss, after that we can start thinking about the profitability. But even if we are not able to recover the investment or maybe the cost of production, then it creates a problem for us. So, break even point, when you talk about the accounting break even point, there we simply talk about the level of the no profit no loss, or that point where the firm incurs no profit no loss and where the cost of production is equal to the value of the sales, or the value of the sales is equal to the cost of the production. In the accounting break even point we discussed that we keep in the numerator your fixed cost which is being incurred in the cash plus the fixed cost which is non-cash, which is depreciation. So, we have to recover the full. So, if we are recovering that cash and non-cash fixed cost, we divide it by the contribution margin, which is the sales value minus the variable cost. And in case of the cash break even point, we simply can divide or maybe keep in the numerator only the cash fixed cost, which currently we are paying for paying of the salaries, for the administrative expenses, for the general expenses. So, all that we are to divide those cash fixed expenses being incurred in the current period by the contribution margin again. So, we have seen that level of sales as per the accounting break even point is 9 million rupees, and in case of the cash break even point it was 3 million rupees. So, it means you can understand what does it mean that up to 9 million rupees of the sales will be earning no profits. Right, the firm will not be earning, this flour mill will not be earning any profits, and after the sales which we make, total level of the sales is 1.8 crore or the 18 millions. So, 18 millions sales means up to 50% of the sales there is no profit, but after for the remaining 50% of the sales, yes, they will be giving us the profit. And in case of the cash break even point where we have to only recover the cash fixed cost, we could find out that we will be attaining the break even point or reaching at the break even point very early, whereby simply what we can say that by selling just for 3 million rupees the cash fixed cost will be recovered, right. So, that was all about the accounting break even point and the cash break even point. Now, as I told you in the previous class itself that now we will be learning about the financial break even point. I think you have not heard about the financial break even point, which you will be I guess that you will be hearing for the first time, and you will learn also how to calculate the financial break even point. And financial break even point is different from the accounting break even point. And on this the focus is on the NPV of the project, and not the accounting profit. Under the break even point we talk about the accounting profit, but under the financial break even point we talk about the NPV of the project. And for finding out the financial break even point, we try to find out that at what level of sales will the project have the 0 NPV. At what level of the sales the project will have a 0 NPV, because in financial terms the break even point is seems to have been achieved when the NPV of the firm is 0, right. So, normally also in the NPV analysis our decision making process remains that NPV of the project minimum should be 0, it should not be negative. If it is positive, very good, but if it is 0, even then we can think about going ahead with the project. So, here in case of the financial break even point we try to find out the level of sales, In the other cases we were trying to find out when we discuss the NPV and IRR situation or those techniques for the evaluation of the capital budgeting proposals, there we discuss so many things. Cash flow was the one important criteria, cash outflow and cash inflow, and then we had to have the discount rate and other things. But here we only try to find out the level of sales, the level of sales which we have to means finally you can say make in the market, which takes the firm to the level of the NPV, where the NPV becomes 0. So, it means financial break-even point says that at what level of the sales will the project have a 0 NPV, because net present cash outflow, how much is going out currently, right. How much is the cash outflow, that is in both the cases. The current cash outflow means the cash outflow in cash as well as the in terms of the non-cash, that is the depreciation cost. So, both we have to try to find out that the total outflow has to be compared with the present value of the inflows, and we want to find out that level of sales where the NPV of the firm will be 0. So, how we can find out that level of sales where the NPV of the firm will be 0, that can be easily understood or can be realized by means taking this example forward. For example, I am again taking the figures of this Raja cash flows, particularly cash flow figures of Raja flour mill, and this flour mill project will help us to understand that how to calculate the say financial break-even point, and then means will be calculating here by taking these particulars, these information given to us, will be calculating that how the financial break-even point can be calculated. So, financial break-even point, financial break-even point, right. So, we have to calculate the financial break-even point. So, we are taking the example of this previous one which we used for calculating the accounting break-even point and the cash break-even point. With the help of same example, we will be calculating the financial break-even point. So, first of all what we have to see here is what is the variable cost. If you talk about the variable cost, it is how much? Variable cost is in terms of percentage, it is 66.67%. Variable cost is 66.67%, it is already given to us. So, we have to take this cost and we start with this variable cost, because it is important. This cost is important to calculate something which is called as contribution, right. And for calculating the break-even point, because break-even point is basically the concept of marginal costing, right. And in the marginal costing we do not end up directly to say or jump to calculate the profits by subtracting the total cost from the sales, but we move step by step. So, from the total sales we subtract the variable cost, we arrive at something which is called as contribution, and that contribution is called as contribution. Or why it is called as contribution? Because that contribution is a contribution towards meeting the fixed cost. So, we know like absorption costing, in the absorption costing we subtract the total cost variable plus fixed from the selling price or the sales value. So, we end up directly to the profit, but in this case for calculating the break-even point we follow the contribution approach, and in the contribution approach we take the sales first, which is already given to us or calculated, and then from that at the first go we subtract the contribution, and that is called as a contribution because that is a contribution towards meeting the fixed cost. And from the contribution, when you subtract the fixed cost, you are at the level of the, or you are able to find out the profit, right, operating profit. So, same process will follow here, that is the variable cost 66.67%. Number 2 is now we have to find out the contribution. We have to find out the contribution, and in the contribution how we can find out the contribution, because if this is a level of the variable cost, so it means the level of the contribution is already means you can find out that is sales minus variable cost. So, sales are 100, so means in terms of percentage, and variable cost is a 66.67% of the variable cost, it means contribution is 33.33% of sales. This is the 67% you can say of sales, and it is the 33% of again sales, right. And then we have to now take into account the third thing, that is the fixed cost. Fixed cost is how much? fixed cost is rupees how much? 1 million. Fixed cost is rupees 1 million. It is given to us. If you go back to the problem, this is the fixed cost which is given to us. This is 1 million and this is a depreciation 2 million. We are taking this. So, fixed cost is rupees 1 million and number 4 is the depreciation, and depreciation if you take is how much? That is rupees 2 million. This is rupees 2 million. So, number 5, pre-tax profit, pre-tax profit or profit before tax. If you calculate the pre-tax profit here, you can easily calculate like 0.333 into sales, 0.333 into sales, the information is given is the into sales minus something we have to write here is rupees 3 millions, right. 0.33% of sales is the contribution. This is the contribution and this is the fixed cost, right. This is contribution and this is the fixed cost. So, finally, what will be the net result when you from the contribution, when you subtract the fixed cost, you will be arrived at something which is called as the pre-tax profit, right. And now we go for the tax rate. Let us go for the tax rate. What is the tax rate here? Tax rate we are assuming here is that it is already given, I think. Tax rate, yes, it is given here. Taxes we have calculated is the 1000. So, against the pre-tax profit of 3000, if the tax is 1000, it means the tax rate is 33.33%, 33.33%. So, tax at the rate of 33.33%, 33 at the rate of 33.33%. This is a tax at this rate. We have to calculate the tax at this rate of the percentage, and if you calculate this tax rate percentage, you can calculate that what is going to be the tax value. So, this is the in the percentage terms, right. So, if you take the tax here at the rate of 33.33%, so it will be how much? You can say that is 0.333 again into, now you take this amount, this, right. So, we take these 3 values here and 0.333, because again we have to write the same figure. So, it is the tax part and 0.33 of sales, because we are multiplying this, the above equation same, and minus how much? Rupees 3 million, which is the fixed cost, minus 3 millions is the fixed cost. So, this is the tax rate, this is the contribution margin and this is the fixed cost. So, it means this component becomes, component inside the bracket becomes the profit before tax, pre-tax profit, and then the tax rate when we are multiplying with 0.333. So, you are finally coming up with the something which is called as profit after tax, PAT. We are calculating the PAT, profit after tax, which will be 0.667 and other things remaining the same, 0.333, that is the profit after tax, 0.667 into 0.333 sales minus 3 rupees 3 millions minus rupees 3 millions, that becomes the profit after tax, because it is the 0.33 is the tax rate. So, profit after tax is the 1 minus 0.333 is equal to say 66.67% of the profit is, means pre-tax profit is going to be the post-tax profit, because 1/3 of the profit is paid as the tax. As we have paid in the previous this thing, we have also paid out of the pre-tax profit, we have paid the 1000, which is the 33.33% as the tax. So, pre-tax profit we have calculated, right. Now, we are going to calculate the cash flow, right. We are going to calculate the cash flow. So, what is the cash flow now available with us? This will be, you can say, column number 4 plus column number 7. Column number 4 is what? Depreciation. Column number 7 is PAT. So, what is the depreciation here? This is rupees 2 million plus we are taking this same amount 0.667 into 0.333 of sales, this is of the sales 0.33 of the sales minus 3 millions, minus 3 million. So, if you take this total amount here, we will be able to find out the final cash flow amount, and if you take the final cash flow amount, you have to means in this what is the profit after tax, in this profit after tax you have to add up the depreciation amount which is a non cash expense. So, this becomes the cash flow which is sum total of it. If you solve this, this will become as rupees 0.222 of sales. This is the cash flow we have already calculated. So, it means this cash flow is we have calculated from this entire analysis, and this cash flow is only for 1 year, right. But what is the life of the project here? We are assuming here the life of the project is 1 to 10 years, means 10 years. So, it means for all the 10 years this much of the cash flow will be coming or the firm will be earning. So, what you have to do now is you have to calculate the present value of cash flow, present value of the cash flow. So, if you calculate the present value of the cash flow, so what you have to do is, because it is going to be in annuity, right. So, you have to do is 0.22 of sales, right. So, what we have to take here as the present value interest factor for annuity, and that is for how much, for 10 years period of time, and at the rate of how much, 12%, right. That is given to us, the discount rate is given to us is the 12%, or we have already assumed it as a 12%. So, it means if you say discount it as the annuity, because we have taken here as that is the present value interest factor for annuity for a period of 10 years, and the discount rate is 12%. So, if you discount this by applying this discount rate of the 12% for a period of 10 years, so you will be coming up here with the value of something which is called as 1.254 sales of the sales, 1.254 of the sales. So, it means we have got this amount 1.254 of the sales, and this amount is called as the present value of the cash flows arising out of the say project. So, now what we have to do is, our objective is to find out the financial break-even point, and as I told you, the financial break-even point is means the objective of finding out the financial break-even point is to find out that level of sales where the present value of the project is 0. So, it means in this case you can say, now we have to find out the present value of the sales where the NPV of the project is you can call it as when the NPV of the say we have to find out the amount of the sales where the NPV of the project is 0. So, in this case what we have to do is, what is the total investment we are making in the project? The investment we are making here is of the 20 millions, right. So, it means the formula can be for the financial break-even point, present value of cash flows should be equal to sum total of, means present value of all the cash flows should be equal to the investment, should be equal to the investment. So, it means if you take this as the investment, or it should be equal to the investment. So, if you take the investment here, so this is the investment, right. What is the present value of cash flow? We have already got the present value of the cash flows here, and this is the present value of the cash flows, which is 1.254 of the sales, 1.254 of the sales. We can again means if you write it, we will say that this is the present value of the sales, that is 1.254 sales. This is the present value of the cash flows. This is the present value of the cash flows. So, now what you have to do is, present value of the cash flows is how much, 1.254 sales is equal to how much is the investment? Initial investment is how much? Rupees 20 millions. This investment is the rupees 20 millions. So, it means if you solve this entire process, you will be able to find out level of sales will be here is how much, rupees 15.95 millions. If you solve this, it will come up as rupees 15.95 million. So, what this is the figure of the 15.95 millions. this figure of 15.95 millions, we have got some figure which is called as the sales, and this is the value of the 15.95. So, it means this is the financial break even point, that a point of means the amount of sales which will take the NPV of the project to the 0 level, or the level of sales where the NPV of the project will be 0 is 15.95 millions, is 15.95 millions. And if you compare it with the accounting break even point, if you compare it with the accounting BEP, right, how much was it? If you recall it, accounting BEP was how much? Accounting BEP was, if you recall that figure, that was 9 millions. It was 9 millions, and if you call about the cash break even point, it was 3 millions, right. So, these are the 3 figures. This is called as the financial break even point, FBEP, right. This is the financial break even point, this is the accounting break even point, and this is the cash break even point, right. So, this is the lowest one, which is the 3 million rupees, and why it is the lowest one? Because we followed the formula, that is the fixed cost divided by the contribution margin ratio, CMR, and in this case we talked about the fixed cost which was only 1 million, which was the cash fixed cost. So, we had to recover only the smallest amount, only 1 million from the contribution margin ratio. So, because of this reason we were able to reach at the cash break even point by just selling the total amount of, or the total product of, or by attaining the level of sales that is equal to 3 millions. But when we added in this one more thing which is called as depreciation, right. So, it became something like this, fixed cost plus depreciation, this became the accounting break even point, and contribution margin ratio remained the same. So, what happened? Our, say here in this case 1 plus 2 plus the contribution margin, we had to say miss this ratio was the contribution margin ratio was this. So, when we have to recover this, it means your fixed cost level went by 2 more times. So, it will became total 3 times of this level when we had to recover this. So, it means in this case we have to sell more, and according to this level, or to attain this level of the say contribution to recover the fixed cost, which is the cash plus non-cash fixed cost. So, we have to increase the level of sales, that this level of the fixed cost will be possible to recover if we are selling worth rupees 9 million rupees. But you see, the main point of comparison is between this figure and this figure, right. Here accounting break even point says that we are reaching at the break even point by just selling for 9 million rupees, but in case of the financial break even point, we say that we have to sell for about approximately 16 million rupees. So, there is a difference of how much? Approximately 7 million rupees, approximately 7 million rupees of the sales. Why this difference of the 7 million rupees of the sales is there? The reason for the difference is that in the accounting break even point, we have not calculated the present value of the cash flows. We have not discounted the cash flows. Accounting break even point, you can say it is a non-discounted criteria. It is the non-discounted criteria, and the financial break even point is the discounted criteria. So, when you are calculating the present value of the cash flows, so it means the total amount which we are showing the cash flows, whatever that amount of the cash flows is coming to us, that is means the value of that is decreasing, because we are discounting it against the cost of capital, and that is 12%. So, when you are discounting, so it means the value to be added into the cash flows means as per the present value of the cash flows, that value is coming down. So, that is the only reason that to attain the financial break even point in terms of NPV, so that means that level of sales where the NPV of the firm becomes 0, we have to sell more, and this is the real analysis here, that actually the cash flows have to be means considered as the discounted cash flows, not as the non-discounted cash flows. That is why always when we talk about even the capital budgeting proposals, evaluation of the capital budgeting proposals, there also we more believe into the discounted criteria rather than the non-discounted criteria, and that is that is the main difference, means explained here also, that accounting break-even point is a non-discounted criteria and the financial break-even point is a discounted criteria, and that is why the level of sales is different. In one case you have to sell for 16 millions, then you are reaching at the break-even point, and that is a real comparison. In the other case you have to only sell for 9 millions, at 50% of sales you are reaching at the break-even point in case of the accounting break-even point, which is a non-discounted criteria. But to arrive at the say financial break-even point, or as per the financial break-even point, we have to sell as high as 16 million worth of the sales to arrive at the financial break-even point. So, the point of difference here is that the level of sales has increased tremendously, almost touching double or 90% of the say accounting break-even sales, because the cash flows considered here are the discounted cash flows. That is why your financial break-even level has gone up from the 9 million of the sales to the say almost 16 millions of the sales to attain the accounting to attain the financial break-even point. But I think you have clearly understood it, because say overall break-even analysis is a very important analysis, and in the risk analysis also break-even helps us to understand that at what level of sales we are able to recover the our investment or the cost, right. So, in case of the accounting break-even point, we talk about the recurring cost, the current cost. We forget the investment cost, that is you call it as, we consider it as a sunk cost, but whatever the say current cost is there, that is a fixed cost in terms of the your say cash fixed cost and the depreciation that we are more concerned about. So, we take into account the variable expenses, we take into account the fixed expenses, and then we try to calculate the accounting break-even point. And you can say that accounting break-even point is basically the, or any break-even point is basically the replica of the payback period. In the payback period also we arrive at the level of sales where we are going to recover our investment, right, our cost. In one way you call it as investment, and in one way you call it as the cost. So, in the break-even point also we are talking about at what level of sales we are going to recover the cost, or when we are going to reach at the break-even point where the cost of production is equal to the level of sales, or sales are equal to the level of the cost of production, because that is the most important point. Once our own investment is recovered, after that now we have to only think about the profitability, and if the project is going on, production is going on, and we have the capacity to produce and sell more in the market, so remaining amount of the sales will give us the profit. So, it means if our own investment is recovered, it means level of the risk has almost become 0, at least we are not going to lose our own investment, and if the profitability is concerned, it can be more or it can be less, right, but it is going to be a profit. But risk is going to be, or if the situation which is going to create a situation, or the situation which comes up as that if we are not able to recover our own investment also, then that is a grave situation and is a very serious situation. So, in the break-even point we are more concerned that why it is a risk analysis tool, because we are more concerned first about the recovery of our own investment. Once it stands recovered, after that we have to think about the profits, whether the profits are high or profits are low or they are moderate. We are concerned, but not that much, as we are concerned about the recovery of our own investment. So, focus has to be, first we have to try to find out that level of sales we are going to recover our own investment. Once the investment stands recovered, after that how much profit is available from the project, there you talk about the profitability, but risk stands fully taken care of, and now the investment is not going to be a risky investment, right. So, these are the three techniques we talked about, is the sensitivity analysis, scenario analysis, and the break-even analysis, where we learned about the three break-even points. After this we will talk about some complex risk analysis tools. I will touch upon those risk analysis tools not in detailed manner, but yes, to the extent possible I will try to explain them. But because we are studying the risk analysis in the capital budgeting, so they are equally important, or at least being a student of finance or financial management, we should have an idea that how many different techniques are there to look for the risk analysis of the capital budgeting projects. So, most importantly used are three only: sensitivity analysis, scenario analysis, and break-even analysis, but these other techniques are also there, and we should have an idea that other techniques are also there. So, after this I will talk to you is the fourth technique, technique of the risk analysis, that is the Hiller's model. Then we will learn about the simulation, and then we will learn about the decision tree analysis. These three more techniques I will talk to you, and after that we will close the discussion on this particular topic, that is the risk analysis of the capital budgeting projects. So, these remaining three techniques, Hiller's model and then the simulation and the decision tree analysis, I will discuss with you in the subsequent classes. Till then, thank you very much.